This might be the easiest trading strategy you'll ever see. It takes less than 10 minutes to find, it uses just one fair value gap, and you could know absolutely nothing about trading and still pull this off. I've been able to pull off trades like this, and this with only one contract. This setup is designed for traders who don't want to sit in front of their charts all day long. Maybe you've got a full-time job, a business to run, or a family to take care of, but you still want to find a way to trade consistently. If you can give the market just 10 minutes a day, this model can give you thousands of dollars in opportunity without costing you your time or your peace. Let me show you exactly how it works. This model is 100% mechanical. No bias, no indicators, no guesswork. It's a if this, then that type of system. You only watch the charts for 10 minutes and you only care about one thing. Did a valid fair value gap form on the 1030 or 1031 candle? If your answer is yes, you may have a trade. If not, you're done for the day. In this video, I'm going to break down exactly what the strategy is and the simple rules that make it 100% mechanical. Then we'll go into the charts and I'll show you real trade examples so you can see exactly how it looks in real time. And finally, I'll show you the real results the setup produced over the last 6 months so you can see how powerful it really is. Here are the 5 steps and exact rules I followed. Step number 1. The first thing we need to do is get in front of the charts and ready to go just a few minutes before 10:30 Eastern Standard Time. If you use TradingView, like I do, then down at the bottom right next to the time, you will see UTC. Make sure to set it to UTC 5 New York and you'll be all set. Step 2 is to wait for a fair value gap to form on either the 1030 or 1031 candle. Now, if you don't know what a fair value gap is, it is a 3-candle pattern, C1, C2, and C3. For a bearish fair value gap, C1 or candle 1's low is higher than C3's high. That space between those wicks is the fair value gap presented on candle 2. Now for a bullish fair value gap, C1's high is lower than C3's low, creating a fair value gap with candle 2. When you see a fair value gap at 1030 or 1031, we can move to step 3 because we might have a setup. Step 3 is the entry window or period of time we will wait for a future candle to come up and tag that fair value gap. This window is 10 minutes long. If price comes up into that fair value gap, we wait for that candle to close. If it's a bearish fair value gap, we will take a short on that candle close, as long as it closes inside or below the fair value gap. Now, if it's a bullish fair value gap, we will take a long on that candle close as well, as long as it's inside or above that gap. If no valid candle closes by 1040, there is no trade and we walk away. Step 4 is setting your stop loss. We will always set our stop loss level at the low or high of C2 or candle 2. For a bearish setup, your stop is the high of C2. And for a bullish setup, your stop is the low of C2. We now move on to step 5, take profit. Your target will be a 1-to-1 risk to reward. Whatever your stop loss distance is, in this example, if it's a 20-point stop loss, you're aiming for the exact same amount in profit, 20 points. Once your stop and your profit targets are set, we let the trade play out. There's no management needed. If you follow these steps, you will get consistent, high probable trades with very little effort. Now, before you just jump in, there are 2 special rules we need to touch on, and the first one is about volume imbalances. If the bodies of C1 and C2 or C2 and C3 don't touch, that's called a volume imbalance. We treat that body-to-body gap as part of your fair value gap. Here is a bearish example. If price wicks into the volume imbalance portion of the gap and closes inside or below the fair value gap, it still qualifies. The same goes for a bullish fair value gap with a volume imbalance. Now, I'll show you a perfect example of this in a second. The second special rule is based on double fair value gaps. If a fair value gap forms at 1030 or the 1031 candles, we will combine them and treat them as one fair value gap. Everything else stays the same. All right, now that you know exactly how the 1030 setup works, let's take a look at the charts and see it in action. I'm going to walk you through real examples so you can see exactly how this model behaves, where the fair value gaps form, how price returns to it, and what the actual entry candles look like in real time. And make sure you stick around to the end of the video because I'll be showing you the full 6-month backtest, every trade, the win rate, and exactly how much the strategy made trading with just a single mini contract. So with that being said, let's jump into the charts. Okay, so here we are on the charts and we are sitting right here at 1029. So we're going to move this forward 3 minutes and see if a fair value gap forms. So you can see here's 1030, 1031. These are the only 2 time frames that we're looking for. And as you can see, we have a fair value gap that forms right here. So we're going to go ahead and mark that fair value gap. And let's go ahead and move this out. There is our first presented fair value gap. So now that we have a fair value gap made here at 1031, all we have to do is wait for price to come back down and tag this fair value gap. As long as it's before 1040, we will take a trade. And there we have it. We have an entry opportunity. The candle wicks inside the fair value gap, but closes either inside or above for a bullish fair value gap. And that is exactly what we're looking for. So at this point, we would look to take an entry right here, and we're going to look for a long position. And the first thing that we're going to set is our stop loss. Our stop loss is the low of C2. So because this is our fair value gap, this is C1, C2, and C3. We want, when we set our entry right here, we're going to set our stop loss to the low of C2. C2 is the fair value gap, so we're going to set our stop loss right there. That makes our profit target going to be somewhere around 12 points. Our next thing that we're going to do is line up our take profit to be a 1-to-1 risk to reward. So that is going to be our profit. We can see our stop loss is 12.7 and our target is 12.7. So now let's set our stop loss at our targets and our take profit at our high. And there we go. We have our stop loss set and our take profit. Let's let this trade play out and see what happens. And on the very next candle, it just moves aggressively. You could have gotten a lot more, which we'll talk about that in the next setup. Our goal is to get a 1-to-1 risk to reward. This is what it's based on. I actually tested a 2-hour trade setup and it failed miserably. The most success is doing a 1-to-1 risk to reward. Let's look at our second example. All right, here is our next setup opportunity. We are sitting in front of our charts before 1030, and now we simply wait for a fair value gap to form at 1030 or 1031. And as you can see, we have a fair value gap that has shown up at 1030. There's our fair value gap. We will drag this out. And now what we're going to do is simply wait for price to come back down and tag our level. There we have it. This is another bullish example where price wicked into the fair value gap but closed above the fair value gap. That makes this a valid entry. Our entry is going to be based on where the close of this candle is. In this case, it's going to be right around here. When we're setting our stop loss, we go back to the fair value gap candle, which is C2, and we're going to set our stop loss at the low of C2 right there. Let's go ahead and drop our entry levels, our take profit areas. So we have our stop loss going to be set right there. That's 10.75 handles again. And we are going to look at this one right there. That would be our profit target. Now, I want to add another option. If you're looking for a bigger rule, there is an additional rule that you're going to have to follow. And that is going to be once you hit your take profit, which is a 1-to-1 risk to reward, you must move your stop to break even. So in this case, we're going to move our target to be the high right here. But as soon as we hit our level right here, this level, we're going to move our stop to break even, and we're going to see if we can get a bigger move. Let's go for 20 handles and see if we can get a bigger move because of that. So here's how this would play out. We're going to take our entry, we're going to set our stop loss, and then we're going to set our take profit at the high. If you think price is running for liquidity, and many times it is running for liquidity. So we're going to move this along here, and there, right there, you see how it wicks our take profit. When we wick our take profit, you normally would be out of the trade. You would have made 10 handles. But in this case, you decided you wanted to go for more. You can either take a partial profit right here, or you can take no profit and go for a bigger move. But your requirement is you must move your stop to break even. So we're gonna move our stop to break even right here, and then we're gonna see if this trade plays out in our favor. Price continues, comes back down. There it is. We hit our profit target, looking for a bigger move, protecting ourselves, because this model is based on a 1-to-1 risk to reward. Let's go to our third example. Here we are on our next example. We're sitting prices just about to hit 1030, and we're gonna let this play out to see if we have a fair value gap at 1030 or 1031. And guess what? We do. We have a fair value gap at 1030 right here. Now this is unique. Remember when I told you I'm gonna give you a good example of a volume imbalance? This is that example. If we take a closer look at C2, this is our fair value gap, right? This is our fair value gap. This is C1 right here. This is C2. So if there's a gap between the body of C2 and C3, we must include this volume imbalance with this fair value gap right here. And so that's what we're going to do. We're going to include that volume imbalance or that fair value gap to reach up into that volume imbalance. Now, look what happens as a result of us including that volume imbalance. Here is the wick of the 1032 candle. It does not go into the fair value gap when we don't include that volume imbalance. This is why we include volume imbalances, because that is treated like a fair value gap. So in this case, this would be an entry for a trade. You can see the volume imbalance and the fair value gap combined. You see price enter right there. So because of that, because we have our candle right here entering the fair value gap, we are now setting our entry at the close of this candle. Our entry would be right here. Because of that, we now set our stop loss where? Based on the fair value gap's candle's low. This is another bullish example. So this is actually a very big move. So we're gonna set our entry right at the close of the candle. We're gonna move our stop loss to be the low of candle C. That's a 27.5 stop loss. So what is our target? Our target is 27.25. Right in the middle there, it says risk to reward. It tells us our risk to reward is 1. That is what we're looking for. So we're gonna take a long entry here. We're gonna set our stop loss at the low and our target at the high. There we go. And let's go ahead and let this trade play out and see what happens. As price moves, one thing you want to make sure you're aware of, there we go, price hit it. These have all been examples in the month of November. So if you're wondering, why are we only seeing bullish examples? Because November gave us bullish setups. This target gave us a profit of $555 for this trade. Let's go into our next example. Now that we got a good idea of how we can use this model, we're gonna move a little more quickly. We're going to let this play out here to give us a fair value gap. There it is, 1030. Mark this as our fair value gap. There's our fair value gap. Now we're going to set our entry, which this is an actual short trade. So let's go ahead and set our entry here, our stop loss here, and our take profit at the low. Now let's go ahead and let this trade play out and let's see exactly what happens. It's in our direction right away, but ends up actually stopping us out for a loss. As a result, this loss was about a 200-point loss as a result. You're going to get losses in any setup, in any model. This is an example of one. Now, this was a perfect example of a day where this model doesn't give us a setup. Now, for some traders, that might sound like a downside, but for the people this strategy was built for, it's actually the point. This setup is designed for busy people who have a job, a business, or just can't sit in front of the charts all day. This model consolidates your trading window down to 10 minutes. And because we are only giving the market 10 minutes, it only shows up about 4 to 5 times a month. But don't worry, we're going to supplement this strategy with another model here shortly. Here are a couple more examples of no trade days, and then we'll take a look at the win rate and profit this strategy made over 6 months of backtesting. All right, here's our next example. We are set at 1029. We're sitting in front of our charts, and we're going to see if price gives us a fair value gap. And there we go. We see at 1030, it gives us a fair value gap. But what happens? Price closes through our level, removing our opportunity to take a trade. In a bearish setup, we need to see price wick into this fair value gap and close either inside of the box or below the box for this to be a trade example. So as a result, there is no trade for us today. Let's go to our next one. All right, here's our next example, and it's the last example we're going to be. And this is an example of a no trade day. It's very simple. Here is candle 1030 right here, and here is 1031. If we don't see a fair value gap in those two candles, there is no trade for us today. Now, this strategy over the course of 6 months had a 68% win rate and made almost $7,000 over the course of 25 trades, 17 winning trades and 8 losing trades. You can see that there is a consistent growth in the P&L chart over 6 months with very little drawdown, which is exactly what we're looking for in any strategy. Now remember, this setup isn't meant to keep you glued to the screen all day. It's part of a series I'm building for traders who want consistent results without sacrificing their time. This 1030 model only requires about 10 minutes of focus, but the next strategy in this series gives you a little more room to work with. It's called the 3 p.m. reversal. This one happens inside of a 45-minute window, but in most days it sets up within 30 minutes or less. Just like this 1030 model, it's built around one fair value gap. So it's super simple to understand, but there's a twist that makes this one of my favorite setups to trade. You'll have to watch that video right here to find out more. We'll see you in the next one.